where the market stands this evening and what traders will be watching for the next session. The precious metals story over the past day has been about speed and about reversal. What had looked like a momentum-driven surge, helped by a weaker US dollar and heightened geopolitical nerves, flipped into a sharp sell-off. The key trigger was a rapid change in expectations for US monetary policy and for the credibility of the Federal Reserve, after President Donald Trump moved to nominate Kevin Warsh as the next Fed Reserve chair. That nomination mattered because markets treated it as a signal. It was read as a shift towards a more orthodox, more inflation-focused approach at the top of the US central bank. And that in turn pushed the US dollar higher and sent US government bond yields up. Both moves tend to put pressure on precious metals because gold and its peers don't pay interest and because they're priced globally in dollars. When those two levers move together, the effect can be sudden, especially when a rally has already pulled in a lot of fast money. We'll start with gold because it set the tone. Gold is still the reference point for the whole complex, and when it turns sharply, it often drags the rest with it, even when the underlying industrial stories for silver, platinum and palladium are different. According to Reuters, spot gold fell by about 4% in early Friday trade after reaching a record high on Thursday of around $5,594 82 cents an ounce. Reuters put gold at roughly $5,183 an ounce during the pullback. Other reporting described even larger peak-to-trough swings during the most volatile moments before prices steadied. The key point is that the move wasn't a gentle drift lower, it was a fast repricing with sharp intraday swings that told you liquidity was thinner and nerves were higher than they'd been during the climb. That's a very large move for gold in a short space of time. It's also a reminder that when the market becomes crowded and when positioning is heavily one way, the unwind can be sudden. In plain terms, if too many traders are on the same side of a trade, a change in the story can force them to exit together. That can turn a normal dip into a sharp drop. It can also create a feedback loop where falling prices trigger stop losses, and those stop losses add to selling, which pushes prices down again. The Financial Times described the move as a rally going into reverse. It reported gold falling by as much as 8% at one point before stabilizing at a smaller decline. It also pointed to a cooling of speculative froth, including actions in China that were aimed at abnormal trading. That matters because when a market is being driven partly by speculative flows, any signs that authorities are leaning against excessive activity can change behavior quickly, even if the underlying reasons people own gold haven't changed. The immediate catalyst, though, was the Federal Reserve story. This wasn't a slow shift in inflation data or a gradual change in central bank language.